Exchange-traded funds, ETFs, are primarily associated with index tracking and growth investing, but there are many that offer income by owning dividend-paying stocks. When they do, they collect regular dividend payments and then distribute them to the ETF shareholders. These dividends can be distributed in two ways at the discretion of the fund's management: cash paid to investors or reinvested into the ETF's underlying investments. Timing of ETF dividend payments are similar to an individual company stock. An ETF sets an ex-dividend date, a record date, and a payment date. These dates determine who receives the dividend and when the dividend gets paid. The timing of these dividend payments is on the different schedule than those of the underlying stocks and vary depending on the ETF. For example, the ex-dividend date for the popular SPDR S&P 500 ETF, ticker symbol SPY, is the third Friday of the month of the fiscal quarter, March, June, September, and December. The record date comes 2 days prior to the ex-dividend date. At the end of each quarter, the SPDR S&P 500 ETF distributes the dividends to shareholders. Each ETF sets the timing for its dividend dates. These dates are listed in the fund's prospectus, which is publicly available to all investors. Similarly to any company's shares, the price of the ETF often rises before ex-dividend date, reflecting a flurry of buying activity, and falls afterward as investors who own the fund before the ex-dividend date receive the dividend, and those buying afterward do not. The SPDR S&P 500 ETF pays out dividends in cash. According to the fund's prospectus, the SPDR S&P 500 ETF puts all its dividends it receives from its underlying stock holdings into its non-interest-bearing account until it comes time to make payments. At the end of the fiscal quarter, when dividends are due to be paid, the ETF puts all the dividends from the non-interest-bearing account and distributes them proportionally to all the investors. Some other ETFs may temporarily reinvest the dividends from the underlying stocks into the holdings of the fund until it comes time to make a payment. Naturally, it creates a small amount of leverage in the fund, which can slightly improve its performance during bull markets, rising prices, and slightly harm its performance during bear markets, falling prices. The second way to be paid is through reinvesting your dividends. ETF managers also may have the option of reinvesting their investors' dividends into the ETF rather than distributing them as cash. The payout to shareholders can also be accomplished through reinvesting in the ETF's underlying index on their behalf. Essentially, it comes out the same. If an ETF shareholder receives a 2% dividend reinvestment from the ETF, they may turn and sell those shares if they would rather have the cash. Sometimes these reinvestments can be seen as a benefit, as it does not cost the investor a trade fee to purchase additional shares through the dividend reinvestment. However, each shareholder's annual dividends are taxable in the year they are received, even if they are received via dividend reinvestment. The bottom line is, although ETFs are often known for tracking broad indices such as the S&P 500 or the Russell 2000, there are also many ETFs available that focus on dividend-paying stocks. Historically, from 1930 to 2022, dividends have accounted for an average 41% of the total returns of the stock market, and a strong dividend payout history is one of the oldest and surest signs of corporate profitability.